Yes, good afternoon, everyone. My name is Devon Drew, founder and CEO of DFD Partners and DFD.ai. DFD.ai is the first of its kind bi-directional AI-powered tech platform that connects advisors to asset managers and their ideal clients. Today, we're happy to be joined by Kerusso Capital Management. This presentation on uncovering value in an inflated world is approved for 1 hour of continuing education credits for CFP, IWI, which covers the SEMA and the CPWA and RMA, and CFA Institute members are encouraged to self-document and save these activities and report it to the CE Tracker online. We're excited to be joined by Randy Kane and Jasmine Gay of Kerusso Capital Management, talking about uncovering value in an inflated world. Today, we'll talk, among other things, about a robust discussion on Kerusso Capital Management and their investment process, their capital markets assumption, an analysis of potential market contagions, and an exploration of how to find fundamental value in the financial sector. One thing I'm also excited about is we're going to take a global approach today, with Jasmine speaking about the global landscape and Randy talking about the U.S. landscape. Before we do, I would love to take a brief poll of the audience as a barometer. The poll questions will be on the right-hand side. Feel free to put your answer directly on the right-hand side and also in the chat, and I will launch that question now. Now, the first poll question: which asset class do you feel is more undervalued? The U.S. or the international equity markets? And I will give you all approximately 30 seconds to answer. While we are waiting for the audience, curious, Jasmine, Randy, what do you think here?
Jasmine?
Well, I would say, when you look at the performance for the last 10 years, I think it's fair to say that the international performance hasn't kept up to pace with the U.S. for the last 8 out of the last 10 years. So I think the international markets are kind of prime from a valuation standpoint to start to turn around.
And I would just add to that in terms of the markets, one of the things we have to be a little bit careful about and concerned about is focusing, as Jasmine had mentioned, the frequency of underperformance, because there could be a reason for the persistency of them. Quality of companies, fundamentals, and valuation absolutely matter. And so as we look at the two, I think that there can be investment opportunities across the global landscape, some outside of the U.S., as well as some within the U.S. And so by focusing on one versus the other, that may be something in terms of a diversified portfolio we have to do. But at Caruso, we think that there are opportunities that can be found throughout the globe.
Well, I think it's a good time to get the audience's answer, and we appreciate the audience for responding to this. And overwhelmingly, 100% of the audience is saying that international is more undervalued than the U.S. markets. Does this surprise you at all? I mean, anytime someone's on one side versus the other, it's maybe some people might want to take a contrarian view. What are your thoughts there?
For me, it doesn't surprise me at all. I think people are just looking at the comparison between the two landscapes, and the U.S. has done really, really well, and domestically we have done well. I think, when you're looking abroad, the underperformance has been there, and you're starting to see maybe some turnarounds on policy, some things that make things a little bit, interesting, to say the least. So I think from that perspective, international markets being the favorite in this answer isn't surprising.
Okay, we appreciate that, and thank you for the audience for participating in polling questions. I gotta also ask, Kerusso Capital Management. Now, Randy, I've actually been a fan of yours for a while. even back to the Herndon days when you're managing, $10 billion of, of institutional capital.
Yes.
Just curious, man. So who is Kerusso Capital Management, and what do you want the audience to know about it before you about your firm before we get into the presentation?
Absolutely. Devon, thank you so much again for the platform, for the opportunity to share. Caruso, basically, I would say, is a culmination of a nearly 3-decade investment career for me, where I've had the opportunity to work with some tremendous people in multi-product, multi-strategy firms. And for the first time in my career, been able to be in one that is focused. I am a value investor, but I've had to share shelf space with growth investors, with fixed income investors. And here at Caruso, we are a value boutique. We launched with our flagship strategy, 2 decades plus of top decile performance in large cap value, with the belief that the approach that we have to investing is something that is not limited by geography or market capitalization. And so as a result, I will say Caruso is the firm that you can look to for a solution in the value world, be it large cap, be it, as Jasmine represents, a non-US. And then we also have some things in the lab regarding other capitalizations, such as small cap, that we're working on. Again, believe that our approach to investing, our unique differentiated approach, is something that is proven to be value added and something that clients should consider as far as their investment solutions.
Awesome. And then how did you end up get connected with Jasmine?
Well, the connection with Jasmine actually began back in 2008. When we were building out our first, I'll say, incarnation of our analyst team, and we hired Jasmine directly out of college from Spelman College, where she was an economics major, and had the opportunity to work with her in her first sector. I was the portfolio manager responsible for energy, and Jasmine came in and we had assigned her that as a sector for her to kind of cut her teeth on, so to speak. And she did a phenomenal job with that, and she gained additional responsibilities. And by 2017, almost 10 years later, she was actually appointed as the portfolio manager for our mid-cap value strategy. So Jasmine and I have a long history together, as well as both of us now being Blue Devils, in terms of her getting her MBA from the Duke Fuqua School of Business in 2017, and me getting my Doctor of Ministry degree earlier this year.
Well, congratulations, and congratulations on a good football team as well this year. It's probably the first time in quite some time you're able to brag about Duke football. But let's talk markets. I mean, coming into 2023, there's a lot of folks that were bearish and thinking that high chance of recession. Here we are, up 20% later, even though a small percentage of stocks is generating those returns. But what are your thoughts from Q4 and onward?
I think from my perspective, it's been a call for a recession in the US for quite some time, right? So I think we're moving into kind of a soft landing. And there's been some calls around the world for a lot of slowing, right? And there are some things that we expect to see. There are some things that we're starting to see. But I think what's important is that we're not chasing the market. I think the unique thing about Caruso is that we have a process that we follow through and through. There's a way that we're looking at value. There's a way that we're assessing the market, and we're not following trends. We're not trying to guess to see where the market is. We're looking at the fundamentals and the valuations of these companies. And when there's a disconnect where the fundamentals are still good and, there's some time, or maybe the company's going through a season, we give it that time and we invest in quality companies that are undervalued at the moment. So I think, there's been a call for a recession in the US. There's probably some cause for, some easing in Japan or for some pickup in Japan. But, there's a lot of people that are going to be ahead of the gun. I think we have a process that makes us very patient and willing to see kind of what's really going on in the market and seeing what's really impacting these companies.
And Devon, just kind of echoing what Jasmine is saying in that regard, the way we like to describe it is with Caruso, we're not trend followers. We like to believe we're actually one step ahead of where the market should actually be going because of our focus on fundamentals first, and then seeing if the market is actually appropriately valuing companies, industries, and sectors based off of those fundamentals. We take advantage of the somewhat, I guess, would be considered behavioral finance mindset of pessimism and optimism, that things tend to go to extremes. And the extremes that we're seeing in different cases provides opportunities for us. In many cases, again, in contrarian fashion, but not simply seeking to be contrary, but going opposite of where the market is going for the sake of doing so. We are able to be positioned in sectors, followed by industries and companies that the market isn't favoring right now, but by the fundamentals, we think the market should be moving in that direction. And over time, we've been rewarded for doing so.
No, thank you for that. So I mentioned DFD.ai, and on our platform, we have asset managers like yourself. We have financial advisors like folks in this audience, and we also have accredited investors. And we poll these accredited investors. And overwhelmingly, it seemed like over 80% of the accredited investors were optimistic and bullish going into 2024. As value investors, I'm sure there's a little pause when you hear, that the end investor is optimistic, because if the end investor is optimistic, we probably, the Dalbar study says we should be going in the opposite direction. What fundamentally gives you either pause or or excitement, in Q3 and Q4?
I will say, Devon, that one of the things that, from a contextual standpoint, that needs to be considered is one of the key focal points is interest rates, and the concern whether the Federal Reserve as well as other sovereign nations are going to continue to raise rates. And one of the things I think has been left out of the conversation is what is a normal and expected level of interest rates. We went through what I would like to term as another Great Depression because of COVID, and the Federal Reserve as well as other sovereign nations threw everything they could at basically getting the world back on track as quickly as possible. Well, it appears that the world is getting back on track in a lot of different areas. And as a result, the necessity of continuing to keep interest rates at close to zero, that's not a policy that can be maintained. Matter of fact, that was not a policy that was basically managing the exception rather than managing by exceptions. And so when we look at the current level of interest rates, when you put it on a historical scale, rates are not high. Although a lot of the market commentary focused on the more recent period of time, the last 2, 3, 4, 5 years, may look at it that way. Rates on the long-term curve actually are not very high at all. And so we think that now you have an opportunity to earn a reasonable return on fixed income instruments, but also there's competition on the other side of the ledger with equity instruments. Now, when interest rates were down close to zero, when you look at valuation approaches such as the dividend discount model, what you find is that you could come up with some astronomical valuations. Now that as rates have begun to move up, valuation has become a part of the equation as well. And we think that as a result, depending on what the sector participation and performance has been, there's a good reason not to believe that the whole market has to perform. So we're not advocating for indexing. But when you break the market down into sectors that have been ignored and have not necessarily gotten the same response in the market as you've seen in some areas like technology, media, and telecom, that there's still tremendous opportunity out there. And just, as an example, Devon, Caruso, with our large cap value strategy, actually had a positive return in 2022. When the markets were down across all major indices, in some cases 20, 30% or beyond that, we had a positive return. And part of the reason why is we don't buy the whole market. We buy where value is available in the market. And so I think that with the investors, we have a discerning approach, focus, and mindset and process, as Jasmine was saying, that's repeatable and consistent. There's an opportunity to find value. So it keeps us, frankly, being very optimistic.
Jasmine, what are your thoughts there?
Abroad, I think, there's some things that are very similar as far as the rate, right? So this week is very heavy as far as the media or the news surrounding rates. You have the U.S. meeting today. I think the Bank of England, Japan, Sweden, who's not meeting this week, right? Everyone's meeting this week. We're talking rates. You have some expectation that the UK, we're at the point where we're going to stop. So we're watching the rate conversation. I'm watching retail sales. There's been some outbreak in China as far as some things that have come out that's been better than expected from a factory standpoint. And the output numbers that are coming out starting to get a little bit better. So we are watching that. But I think we're watching the U.S., as most people know, in Europe, approximately, I'll say about 58% or so of revenues comes from places outside of Europe, right? So what's going on in the global economy matters. The strength of the consumer matters. The strength of the U.S. consumer for some of the companies matter, right? And you have rates going up that makes things complicated. You have oil and gas prices going up, which makes things complicated. So we are watching that. I think in the international markets recently, you saw a really big run up in Japanese names and kind of the market starting to favor that region. But they're fighting inflation like we are. They have subsidies for gasoline. And it doesn't look like oil prices are coming down anytime soon. So, what does that mean for the Japan consumer? A lot of the GDP strength that we've seen from a quarter to quarter basis has come from exports. So domestically, things are not as strong as some of the numbers may say, right? So we're digging into those numbers. We're seeing the drivers. And, even though that's looking at kind of a macro factor, it's always good to be aware of what's going on so you can understand how your companies are going to perform, how they're performing, and why, right? So we focus on the company at the company level, but we always have our kind of minds on what's going on in the market. And I think, we're kind of watching everything right now. Even the conversations on ESG and some of the funding for offshore wind, right? I have a few companies there and, we need more support there. So kind of watching what the regulation environment is going to be and the supporting measures from a fiscal standpoint. All of that's important right now.
When you talk about support, can you speak about what you're looking for these wind companies internationally when you talk about support fiscally?
Well, just looking at, you've seen a lot of infrastructure bills come out in the U.S. to support some of that. In Europe, you've seen some support for EV and the purchases there. I think for some of the ESG initiatives that we have, as far as getting sustainability kind of out there and in the forefront, is going to require some government support. The consumers are not going to fit the bill. They've already kind of expressed some tension in Europe around consumers footing the bill for the EV growth, right? So when you're looking for having these new energies, you have to have some governments that's going to support some of the projects. Few of the projects that companies once bid for, with the inflation kind of numbers going up, it's the costs are going up for these companies, right? So now they're back at the table and they're trying to bid for cost in increases, just to make the conversation work for both sides, right? So I think when you're looking at a lot of the initiatives, a lot of the goals that we have from a global standpoint, just want it to be cleaner, right? It's going to take a lot of government support. It's going to take a lot of consumer buy-in. And until then, we still have to secure the resources that give us our heat and gas and oil day to day, right? So oil and gas has been a sector that, if you look a year or two ago, everyone kind of moved away from oil and gas. ESG was in favor. No one wanted to own an Exxon Mobil. No one wanted to own a big conglomerate. Sorry about that. But those companies are the providers of the resources that we need right now. So there has to be some balance in securing the resources that we need for today, as well as getting us prepared for tomorrow.
I'd be curious about your methodology of how you separate growth from value, right? I was looking at your portfolio, and maybe some people can make the argument that some holdings may be growth, some holdings may not belong where you guys currently have them. But I'm curious about your proprietary methodology to determine what stock could enter your universe.
Absolutely, Devon. I think one of the keys there is to understand that from how we approach the world from an investing standpoint, we focus first on fundamentals, as Jasmine did a wonderful job of articulating a particular area where a fundamental understanding is incredibly important. But we focus on primarily one metric at the outset, which I would say is a very loaded metric. Even so, we believe there's a great deal of complexity built into the simplicity of it, and that is return on equity. which for anyone who's used the DuPont model understands that there are several different levers that drive ROE. But we look at ROE as being the fundamental driver for any company, the fundamental expression of how well a company is participating. The thing about it is different industries, companies, and sectors have different expected levels of return on equity. And we're not a manager that focuses on an absolute hurdle there. What we're focused on within our process is identifying companies on the basis of where they happen to be in the respective universe that we're seeking companies from. We use that as on a relative basis to determine what fair value should be, basically the worth of a company within the overall market. What makes it more so prescriptive for us is when we look at the valuation, and we also look at it on a relative basis. Our expectation, primarily using price to earnings ratios, but also incorporating price to cash flow where appropriate, or other metrics that we get deeper into the screening process. We're really looking for situations where the valuation is at least a 30% or more discount to where the fundamentals happen to be. This allows us, Devon, not only to look at companies that may be of higher return, but also lower return, as well as those that are right around the market. What happens where people may say, are you focusing on growthier companies at particular points in time, or have some growthier companies in the portfolio, is really just a function of the current valuation not properly discounting those fundamentals. For example, one of the large holdings that we've had for many years in the domestic portfolio has been Apple. And people will say, well, with a run up to Apple, where it is, with it being a $2 trillion company at peak, hasn't it basically done enough in the market? I had one allocator asking me about where, if we had at least 30% or more upside, where was the next 1 trillion going to come from in market capitalization for Apple? I'm like, well, that conversation could have been made when Apple was at 1 trillion, when Apple was several hundred billion. And it's not for us to find that specifically. It's a function of the market has not properly valued this company from our perspective, because it has a higher level of return on equity than what the market has, and evaluation is not matching that same level. And this is a unique approach that we've not seen anyone else utilize for identifying individual securities, or in aggregating those securities in a way that it gives guidance on how we do our sector overweights and underweights in the portfolio. And for us, when we talk about value creating opportunities, VCOs, each one of those words is instructive. The value, again, we're looking for a minimum of 30% or more upside. From the creating aspect of it, we're looking for fundamentally sound companies, as Jasmine spoke of at the beginning of our conversation. We're not basically sacrificing there. And because, again, of the pessimism, the optimism that is always prevalent in the market, we're always finding pockets of opportunity to investigate, to analyze, and then potentially add to the portfolio. But then from the opportunity standpoint, Devon, which I think is incredibly important, one of the maxims that we live by is we cannot predict the timing, the duration, or the magnitude of our performance. All we can do is position a portfolio to achieve it. And then by being patient investors, and I think the critical aspect for everyone who's listening is we are investors. And as investors, that doesn't mean we're going to be rewarded in the current week, month, quarter, or even year when we make that initial allocation. But our expectation is over time, we're going to be very well rewarded. And our portfolio right now domestically has about a 5-year holding period with close to a 20% turnover rate. So again, we're very patient with the companies, expecting for that pendulum when we purchase a swing from pessimism to optimism over time.
Gotcha. Do you guys have, can you turn any slides for the folks that may be unable to really hear and maybe just are visual learners?
Absolutely. Jasmine, if you can come forward a couple of more pages, I think we'll be able to articulate very well one more.
And then while we're doing that, we want to encourage the audience to ask questions that we will integrate within the presentation. So the Q&A box is on the top of the screen towards the left-hand side. So feel free to ask any questions, and we'll do our best to navigate and integrate it within the conversation.
Great. And Devon, thank you so much for pinging us on that, because as I was speaking to the process of defining the individual stocks, you should see here, we have all 4 steps of what we do on the domestic side, as well as what is mirrored primarily on the non-U.S. side as far as identifying the value-creating opportunities. And then we look for companies that have a minimum market capitalization of $10 billion and above. We want to focus on companies that have the liquidity, the line of vision of other investors that will make it easy for other investors to see what it is that we're looking at. But one of the key things that we do that stands out is our 32-factor ranking model that has some big bucket areas that we're focused on: valuation, growth, income, and some other factors that we're focused on, as well as when we go through and we're vetting and validating our companies through our SWOT approach, which has us breaking your company down into the 4 key building blocks: strategy, management, operations, and financials, and applying the SWOT framework to that. So as a result, Devon, we see it as we're partnering with companies that we have a great deal of confidence in, that we would expect for investors over time to have the same level of confidence in as well.
Awesome. Thank you for that. So I also have a question for the folks that, are thinking or asking, is now the time for value versus growth? I know we've seen a good run up in growth, albeit probably from about 7 stocks, right? So do you think this time, and this question is for both Jasmine and Randy on both sides, on the global side and also domestic side, is now the time for value?
I would say yes. I think as the market gets more, what's the word that I'm looking for? As there are more news coming, as the data starts to change, and really the landscape for a lot of these companies start to change, I think valuation is going to take a precedent, right? You can't just grow just for growth's sake. You're really going to have to kind of you're really going to have to dig deep. I think tech was a place where, if you bought a chip maker, then you could kind of guarantee that you were going to do well, right? Well, now you have the transportation sector starting to slow. You have the UAW with the strikes going on now. Tech companies are starting to slow. The demand for chips are starting to slow, right? So what does that mean? I think there are some key areas where we've seen a lot of growth. We've seen a lot of market attention that, as things start to slow, you really have to pay attention to the factors of kind of what's driving the companies, what are the fundamentals that are driving the companies, and are these lasting fundamentals that could continue to go.
And Devon, if I can add to that a bit, as you can see, Jasmine does not have the gray hair, and she, like us, does have hair. And so I have had the opportunity to be in the markets for a few cycles. And one of the things I've seen over time is when you get the headlines of value being dead, it's normally the time for you to start sniffing around and start to reconsider that approach. Technology had a renaissance during COVID because we were all homebound. And as a result, the desire for all things technology, media, and telecom took precedence while the rest of the market took a back seat. And so when the idea of will there be a recession, for many of these companies, they didn't have a recession, they had outright depressions because of the lack of demand for their goods and their services. Technology did not have that. Now what's happened is technology got to a level and a run rate that was not sustainable, although valuations implied that they were. And even when you look at what happened this year was basically a rebound from what happened to technology, media, and telecom last year when they were basically down close to 30-40%. The rebound that has occurred this year has not even gotten, if you look at the market from, I would say, probably more of a 2-year standpoint, technology has not even gotten back to where it was when we got the lowest points of 2022. And so there should have been some expectation of bounce back, but collectively, point to point, you've not seen it come back all the way. And to what Jasmine was saying, I think that there has been a case of where growth has come back, but the year-over-year numbers in terms of acceleration have begun to decrease. And for a lot of more so aggressive momentum investors, they don't look at just a year-over-year earnings growth. They look at the momentum, the acceleration of that. And acceleration has begun to turn negative. And so I think that there is a problem that some of these higher multiple companies have, and that is to continue to whet the appetites of more aggressive growth, momentum-oriented investors that they're not going to be able to do. And it's not going to be a function of bad growth. It's just that the growth trajectory is going to slow down. Where we're exposed, we don't have companies that have that same type of expectation built into their valuations. And so as a result, even if the market pulls back, we believe we have the opportunity to have relative outperformance. But for some of these other companies, I think the challenge is going to be to continue to merit the high valuations that they have, or that investors would expect for them to have given the sectors that they come from. And so I think that we're in a position right now where value is very well suited. But the key thing, Devon, is it's not simply, I'll say, a Pavlovian type of value, because people have from a certain perspective that value should be certain sectors. Value from me as an investor is not sector specific, is what you find within the market. For example, in our structure of our portfolio, we're underweight some traditional value-oriented areas. We have no REIT exposure in our portfolio. We're underweight utilities for a fairly significant amount. We are underweight healthcare by a fairly significant amount, traditionally considered a more defensive-oriented sector. Where we're exposed and have greater focus within the portfolio is really in what some would consider to be pro-cyclical areas: financials, energy, materials, and consumer discretionary. The difference being is that those companies, sectors, valuations are not pricing them the same way. And so we think there's tremendous opportunity in the market, but it's a bit more focused. And as Jasmine was mentioning, you had to be in the right place at the right time to benefit at the beginning of this year. So far in the second half of the year, you haven't seen that same level of outperformance. Value has come back into the forefront. And so far for us, we've been able to outperform so far this quarter by somewhere between 150 to 200 basis points versus, growth and value in the market.
So I'm looking at the audience. I see there's a couple folks from Ameriprise Financial, which is your second largest holding. What about Ameriprise what about Ameriprise, gets you excited to make it a, 3.4% of your overall portfolio?
Yeah. It's interesting because what we put out, and this is as of 6/30/23, as of right now, Ameriprise, because of our sector positioning, intra-quarter is actually our largest holding in the portfolio, which makes your point even that much more pronounced. What we like about Ameriprise is that just in general, it gives us market exposure because of the assets that the advisors have under management. But from a strategy standpoint, them giving I'll say an architecture that's a bit more of an open architecture for advisors to bring their RIAs under their umbrella and having the ability to service their clients with product and making sure that they're being able to do so in a cost-sensitive fashion, but also focusing on making sure their clients have a quality experience is something that's very important. Also, it is a scaled business. It is a diversified company across the U.S. and right now within the demographics that I know that you're focused on as well as Devon, even with the millennials, they're very attuned to being aligned with a wide band of investors. So the demographics, when you break it down on the basis of age, they have advisors who are targeting that. When you have on the basis of gender, they have advisors who are targeting that. Even from the generational demographic, with the millennials and moving forward, they're very well positioned for that. And evaluation does not take all that into consideration and account. So we still see it as a very attractive company and still a very value creating opportunity.
Any other of their competitors you guys are looking at or currently own or could talk about?
Well, at the end of the quarter, we did have, I would put them into kind of the bucket of the asset management space. From how we categorize things, we did own T. Rowe Price, but T. Rowe Price was a stock that we sold out of the portfolio on the basis of how we were looking at valuations, as you see the exiting positioning there. But in terms of just asset management in general, we found greater affinity for some of the alternatives with an Apollo, with a BlackRock, and with a Carlyle Group, where we're getting some of the smartest people in financial services basically working for us. Diving deep into some of the alternative areas that investors at the institutional level, high net worth level, are very interested in to see how they can eke out some differentiated, non-market correlated types of returns over time. And so we believe that asset management is still a very attractive area, but you have to pick your spots. At one time, we did own Franklin Resources in the portfolio, but again, because of the combination of valuation and fundamentals, we had to exit there. And that is something where I would say within Ameriprise, that is a particular strength, is that advisors are not generic. They're very unique and differentiated, but in terms of the type of product they have access to, there's not necessarily a party line that they have to hearken to. At one time, when Ameriprise was a part of American Express, that was actually when I first got exposed to the company. There may have been a bit more emphasis on supporting certain brands or certain products, but with the more so open architecture that they have, they can offer, I think, a lot of different types of client solutions.
And then how does this, I'm looking at, I'm looking at your sector exposure. How does this flip, Jasmine, on your side when you look from a global perspective?
And so our sector exposure is actually very similar, and it's because of how we're looking at value, right? So from a resource standpoint or a more cyclical standpoint, we are kind of more exposed or overweight the industrials, materials, oil and gas, and the financials, right? And we are underweight, some more of the defensive sectors. We have underweight to healthcare, utilities. We're actually underweight techs, who's done pretty well, right? So where you would think that valuations have kind of gotten too far ahead of themselves, where we are not in those spaces. We're in spaces that have been less favored by the market. Oil and gas for a time, because of the ESG conversations, it just wasn't favored by the market. Oil prices today are what, $95. You're seeing a lot of the oil and gas companies turn around, which is, something that's not say expected, but we understand that oil and gas isn't going anywhere right now. These are resources that we need today, and these are also some of the players that will be around for the conversation tomorrow. So who's going to be a part of the transition? A lot of these companies are going to be a part of that transition, right? Healthcare, I think, is a very unique space for me, because we have underweight there, but our highest weight in the portfolio is Novo Nordisk, which is a healthcare name. And I think that speaks to the strategy, right? We aren't following a trend. We're seeking to define quality companies, even if they're in a sector that we, from an allocation standpoint, may not want to have kind of a higher exposure to. Novo Nordisk is a great company. They're in the diabetes and obesity space. Recently launched a new obesity drug that also had positive impacts on strokes, and I think it was heart attacks, right? So the clinical trials are very positive. It's been a great performer for us just because they're leading in the space. But we have that exposure kind of across the portfolio, where we're looking at quality companies that are operating maybe in a difficult environment, but they're still quality companies and they can achieve, great returns.
No, thank you for that. And I think this is a good time to actually take a pause and poll the audience for the second time. And then while we're polling the audience, once again, just curious of your thoughts while we pull up the poll question. So poll question is launching now. You'll be able to see this on your screen and also in the chat box as well. So the second polling question: over the next 6 months, which do you expect to outperform? U.S. growth, U.S. value, international growth, and international value. And we will give you all 30 seconds, approximately 30 seconds, to answer this question. Similar to the first question, Jasmine, what do you think the audience is going to say here? Keep in mind, the first poll question, everyone answered international as far as being undervalued. So what do you think the audience would say here?
So I think this is going to be a bit more mixed. Overseas, I think, looking at value and growth, it's a bit different as far as how we're looking at those. I think some of the growthier areas, as far as in technology, are not going to do as well. I think some of the areas in utilities and maybe for like the steel makers and materials have been less favored by the market. So it's a reason to believe that, if things continue the way that they are, if we're seeing strength in China, maybe some of these things will start to turn around from the less favored name. So I think the results are going to be mixed. I think it's going to be a value tilt either way. So US value or global value, or but I think it's a value tilt. I'm not quite sure the
Okay.
region.
Okay. Randy?
I think that depending on how investors approach the thoughts surrounding U.S. value, because several of the large cap, mega cap companies are multinational companies. And so the factors that are impacting some of Jasmine's companies as being ex-U.S. are factors affecting some of our companies in the U.S. as well. So I think that there is an opportunity for these companies to perform, very well in the short run. And so, I'm gonna go with my team, U.S. value on this one.
So, 43% of the audience, U.S. value, right? But it was mixed, so you're both right. 29%, it was a tie. 29% for international value, 29% for U.S. growth, and 0 for international growth. So does any of these results surprise you, or what are your thoughts there? What was the most surprising?
I think U.S. growth was surprising for me. I'm not quite sure which companies in the U.S. we're talking about as far as where they see the growth coming from. So that's a bit surprising. I'm not surprised by the value tilt, though.
I don't know. Like, I looked at it and I saw the first poll, and 100% said that, international was most undervalued, right? And if it's most undervalued, there could be some pent up demand. There could be some positive dynamic change within the tech side or within the growth side. So I thought that there'd be a little more international growth just based off the first polling question. But I guess it makes sense that 29% has that value tilt. So that makes sense. So thank you for everyone who answered the polling question. So pulling over to Randy, what gives you pause, right? We'll start with you there. Like, what gives you pause? I know you're very optimistic on your space and your methodology. Is there anything within U.S. value that is, causing you to lose any sleep, or to really make sure you're, all your ducks in a row as far as your methodology?
Yeah, I would say, for as much as we want to believe that interest rates, in my opinion, are being normalized, there is still, I think, the aspect of companies that have taken advantage of a free lunch regarding leverage that are not very well positioned structurally on balance sheets, and therefore impacting cash flows. How the higher rates could have a negative impact on that. I do think also that there's a challenge in the markets from the standpoint of not so much the fundamental performance of the companies, but a contagion aspect. And what I mean by that is, if you think about what really drove a lot of the market impetus earlier in the year, it was AI related. And now every time you're turning around, they're having AI conferences. Everything is supposed to be AI. And again, I've been around the markets long enough to remember the latter part of the 90s when the world went .com. I mean, back in the 90s, Devon, you, Jasmine, I could have put a hot dog stand on the corner and said hotdogs.com, and we would have gotten $1 billion market capitalization just because .com was added to the end of it. Now, everything has to be AI. And I think that one of the risks that you run with that is, and I wouldn't be surprised if that's not part of the fascination that some may have with U.S. growth, is that AI is supposed to just change the world. Technology is an enabling sector. It's not a sector in and unto itself. Only to the extent that it can impact traditional sectors does technology have actually application and, in my opinion, reason to be strongly considered. And so it is more a function of the customer base that it serves. But also because for the general markets, because technology has become such a big component, if it pulls back, it is going to pull the markets back. That's a fact. And therefore, even when you look at limited capitalization, as numbers come down, there would be selling broad-based across the market. It wouldn't simply be a matter of cash flowing from technology into other sectors. There will be a downdraft collectively across the market. So this is where I think our approach would hold up from a relative return standpoint. But people eat absolute returns. They do not eat relative returns. And so the market coming down could cause there to be more fear in the market, and perhaps because rates have gotten to a more elevated level, a push towards fixed income instruments as well as money market instruments that now have a real yield associated with them, and that could create some pressures for the equity markets. And so that's something where I think it potentially could be short-lived, but I think that is a real risk within the market, is the appeal of other asset classes on the basis of the dominant class growth, technology, media, and telecom having had such a dominant position for so long, unwinding, and people not necessarily moving right into the other sectors available to them.
Gotcha. Thank you for that. And I do have to push back because my platform is DFD.ai. We founded in 2021 before ChatGPT, and I will tell you with 100% certainty, my valuation is not $1 billion. So, so maybe we're doing something wrong here. So Jasmine, same question to you. And there's on the international side, of course, you have the geopolitical risk as well, right? So, what if you had to surmise into maybe 3 things that potentially are giving you pause or allowing you to not sleep as well potentially at night?
I can say that I'm not too much up at night, but I will say this. I'm watching all the conversation around rates. I think different places are at different levels. Japan, I think, meets at the end of the week. That's a big conversation. We have an underweight in the portfolio it was around 7.5% in June. I think it's a bit higher now. So because we're underweight Japan, any shift in policy could be detrimental to the portfolio just because we don't have the exposure there. So I'm always watching those conversations. I'm watching oil prices and the impact it's having on the consumer. So a lot of data, just watching, how sales are doing, how the consumer is holding up. I think the consumer will probably be what keeps me up at night. I think in the US, we've seen the consumer hold up a lot better. We have certain things like student loan payments that start back in October, right? Do you have the discretionary cash to go out and continue to buy things on the more discretionary end, right? So I'm watching that. Like I said, a lot of the companies globally have exposure to the US, ACS, which is one of my industrial companies. They do the Sunbelt. If you look at the in industrial space, but how construction is doing. There's a lot of inflation in the market. Costs are going up. Are companies able to push these costs through to the consumers, which in some case is the government? Are they getting pushback, right? Are margins going to have to come down because they're not able to get those costs pushed out to the customer? So I'm kind of watching a lot of data. Visibility on the UK seems to be, softening. There's a lot of softening there. So kind of watching that from an end market perspective. So, there's a lot to be concerned with. There's a lot to watch right now, which I think makes value even more of an opportunistic, space, just because for a while it was easy to see the growth and understand where that's coming from. Now it's not so obvious.
Gotcha. And from a geopolitical standpoint, are any of your companies that you guys cover worried about, whether it's China, Russia, the BRICS, potential, dollar?
I would say that there's a lot of conversation for me around Europe and China and kind of the EV and what's going on there. The pushback that, Europe has done with China, is there going to be something that happens? The Chinese companies don't have a lot of exposure to Europe, but there's more European companies that have exposure to China, or their plan is to grow in China, right? So if there's some type of trade war, what does that mean for a company like Mercedes? I own Mercedes. That's important, right? So I'm watching that. I own Stellantis. The UAW talks, that's important. But from just the geopolitical risk, I'll say conversations between China and the EU, China and anyone, kind of keeps me up at night.
And Devon, adding to that, I would say for us, one of our key larger holdings, one of our top 10 holdings, is Apple. And we've already seen some of the pushback from China there because of what's happened with the conflict between the US and China on intellectual property and things of that nature. And so to the extent that that becomes a bit more widespread, we think that could be a risk, but that has been a risk for most companies in the U.S. as they venture outside of the U.S. is that sovereign risk coming to bear against them. I would say one of the companies also we have in the portfolio is one of the defense contractors, Lockheed Martin. And there, it can be potential risk on the upside, but the tensions that's continuing to escalate within the world globally is suggesting that, frankly, disarmament is not necessarily going to be the trend in the short run. It could be, wanting to rearm, and so there's an opportunity there. Maybe for reasons we don't find as being all that comfortable and comforting. But if it were to go in the other direction, if there was a resolution somehow between the Ukraine and Russia, that could actually put the defensive stocks in a period of decline, even if it's just from a sentiment standpoint, not outright fundamentals, but less need for that type of protection across the globe from an arming standpoint would, I think, put some pressure on that particular holding and in that particular industry group.
So if that happens, if there was some resolution between Ukraine and Russia and it put strain on defense companies, at that point, would that be attractive and end up on your screens?
Well, Lockheed Martin is on our screen. At one time, we had Northrop Grumman in the portfolio as well. And these companies, again, it's almost, we have conglomerates, they tend to trade at the level of the weakest link or what's being prized as being the strongest aspect of the company. And so what you have with these defense contractors, frankly, they're actually technology companies for the most part, for many of them. There is the actual hardware, so to speak, that they produce, but there's a great deal of technology that goes into it from the communication standpoint and logistics and things of that nature. And so anything that would happen, we would see probably being a bit more opportunistic because we're looking longer term in what these companies actually bring to the table. They did not come to the forefront because of a war, a skirmish, a conflict. They've existed prior to that, and we think there'll be a reason for them to exist, thereafter.
Right. No, thank you for that. So at this point, would love to just open it up to the audience, right? So we have approximately 8 minutes left in the webinar. You both have been fantastic, but let's hear from the audience, right? Let's hear any questions or concerns or thoughts that you might have so far. The first question looks like it is, what role does free cash flow play in your analysis?
I'll speak to that, and Jasmine has something to follow with it. When we're looking at companies, one, from the valuation standpoint, price to cash flow is an important metric that we look at. And one of the things you will see in the characteristics that Jasmine has up for the international portfolio, as well as what will be up for the domestic portfolio, is our price to cash flow metric on both accounts is below that of our benchmark. But what you find is we're not sacrificing anything in terms of the quality surrounding that. For Jasmine and I, in terms of analyzing companies from a financial standpoint and using the SWOT framework, we look at the three financial statements. We look at the balance sheet, we look at the income statement, we look at the cash flow statement. In my opinion, as an investor, the cash flow statement is the most important statement because in some respects, with the income statement, it is what some people would jokingly say what accountants will allow you to get away with. But the cash flow statement is really a sense of the lifeblood of the company, because if you're a growing company that continues to have negative cash flow at the end of the day, then you need to continue to go to the market to recreate the opportunity to have a sustainable business model. And depending on whether the market is favorable to that or not, what price you end up doing that or not, it has an impact on current as well as future shareholders. And so cash flow is a very important metric. Again, to me, it's a bit more important than what you're actually looking at via the income statement. So it's something that we absolutely do look at.
Yeah, and just to add on, I think for some areas, cash flows are very, very important, particularly if you're investing. A lot of the companies that I'm looking at are looking at making investments. If you look at the material space, if you look at the oil and gas space, everyone is trying to transition into becoming a resource company, something that's bigger than just oil and gas or bigger than just steel, right? So what does that mean? How can they invest? How good are they at generating cash, and how are they using their cash flows, right? I think that's something that I'm always watching to understand the health of the company, but as well as how they're investing and kind of where that cash is coming from. So.
Oh, thank you for that. Appreciate that. The next question is, where is Caruso currently available and how can we purchase it for clients? And is there a stated minimum?
Right now, Caruso is in SMA form, and I like to say that as right now. We have conversations with other intermediaries that will give us access to other clients. Now, we also, for the large cap value strategy, are on Schwab Marketplace. And so we actually have the opportunity to create other product without, giving anything away. There are financial intermediaries that stand ready to help us construct in short order mutual fund, ETF, or a commingled trust. And we would love to be on some of the platform providers, as you mentioned. Devon, AER Prize, having a couple of representatives here, have had conversations with some of the executives there. And as the firm continues to grow, that's a platform that we are looking forward to being a part of, as well as with others. And so right now, we're not available in model form, but I will say to those who are interested and engaged, call the people at your home office and say, we heard a great presentation from Caruso. We want to find a way to get engaged, because in our history, Jasmine and I, we have been providers on the platforms of an AER Prize, of a Goldman Sachs, of a Morgan Stanley, of a Merrill Lynch, of a UBS, you name it, we were pretty much there. And we're looking forward to having that access again as we're looking to move forward. And so we want to be available to you where you can access us and use us. But right now, separate account is where we're available. And again, we can be constructors of additional distribution channels based on demonstrated need. And so we're very interested in having that conversation.
Gotcha. And what is your performance year to date? And if it's outperforming, what do you attribute that to? And do you have a slide for that, I believe?
Yes. And Randy, I'll go.
Please go ahead.
Go ahead.
What you would see here for the value strategy, and this is not up to date, we're actually outperforming year to date in our approach right now, and I can pull up something I can't really share, but in terms of our year-to-date outperformance that we have in the strategy, we're outperforming by between about 150 to 200 basis points. And so this is something where we have had strong performance, a lot of it coming through the energy space in the portfolio. That's been one of our key contributors in the portfolio, but we've also had very strong performance actually coming out of financials. And there we would say that our differentiation of owning not necessarily the largest companies in the index, because with the larger companies in the index, what you have are the conglomerates. You'll have the JP Morgans, the Bank of Americas, the cities, and the like. And what I have found as an investor is much more helpful is basically disaggregating those companies. And in disaggregating, what I mean by the companies is each one of those companies, each one of those lines of business within a conglomerate is essentially like a company in and into itself, but the value gets convoluted because it is a part of a conglomerate. So if you look at our financial holdings, you really won't see that. We only have two banks within our portfolio. We own US Bank and we own Regions. But other companies within our portfolio in the financial sector are monoline companies that are some of the best in breed, so to speak, in their particular areas. And so financials has been a strong contributor. Materials has been a strong contributor, as well as energy. And if you think about what we said as far as our positioning, us being positioned in more so pro-cyclical areas, and again, not top down, but bottom up where we're finding value, that has actually worked out well within the portfolio.
Great, thank you. We appreciate that answer and appreciate the questions. So we have a minute left here. Where can folks find you? Do you have a contact slide?
We do not.
Okay. Well, we'll make sure to get that contact information out for you. It is very important to note that to receive continuing education credits, we have marked down everyone's time and attendance and how long you joined the today's webinar. We will be sending out a survey. The link is currently in the chat feed, and this is where you will be able to input your CFP and IWI numbers so that we could report it on your behalf. And then if you could also take the brief survey, that would be greatly appreciated. On behalf of myself, Devon Drew, Randy Kane, and Jasmine Gay from Kerusso Capital Management, we definitely appreciate the time here. Any questions or concerns, any feedback, feel free to reach out. Feel free to reach out in the chat or shoot me an email at devon@dfd.partners, and we will make sure to get Randy and Jasmine any questions or thoughts, or if anybody wants any follow-up. We appreciate the time. Thank you, and we will keep you posted on future webinars.
Thank you.
Thank you.
All right, thanks everyone.